So welcome everybody to Capital Markets Wrap presented by Holly. I think we determined in the green room before this, we're all on the East Coast. We've got New York, Maryland, Florida, and Florida. So Dad, does that mean we can just say good afternoon to everybody, or we should still say good morning to our friends on the West Coast?
I
That way,
think, for example, California accounts for about 20% of national loan production. So arguably 20% of people on this call are from California.
there you go. Well,
No, I'm
good thing
good.
it just turned noon in California. So but you and I are both at MBA Florida, Ira at his desk and James in Baltimore. We have a good capital markets wrap scheduled today. Uh, I'm filling in for Amy Creason, who was supposed to be here but had a conflict come up. And we'd like to say, as always, thank you to our sponsors at Poly. I actually saw Poly just rolled out a good new catchphrase. They said, you no longer have to tolerate the legacy PPE technology of old. Why? Along came Poly, which is a good
Old
move.
wives.
Yeah, Along Came Polly. You ever seen that movie? Along Came Polly, Adam Sandler, Dad? Not an Adam Sandler guy. You can be watching Happy Gilmore 2 when it comes out this summer. Any interest? No.
It was Ben Stiller, but we'll we'll
Or
we'll cut you
better.
some slack.
Oh, yeah. All right. Well, good. There you go. Along came a better Polly, and that was Polly, the modern PPE platform. For those people that want to check it out, Polly.io. There's a product and pricing engine. There's a loan trading exchange. They do data and analytics. They have some AI offerings. Check it out, Polly.io. Big thank you to them. As always, I was talking to my dad a little bit before the show started today. I said, what should we talk about? And he goes, let's talk something new, which I don't read the news, so I don't know what's new. But when you guys think of capital markets, since we last had this show, the second Tuesday in May, what do you feel like is actually new versus us just being up here, being talking heads, kind of repeating the same storylines? Ira, let's start with you, man.
Yeah, so I know this was sort of one of the topics that we had slated to talk about, but still coming off the heels of NBA secondary in May, it seems like the investor appetite for non-QM and AUS jumbo is definitely that chatter has definitely picked up. It seems like we're going to be seeing as in the coming months a lot more offerings of non-QM from your maybe traditional investors that were not offering it previously. Some of the depositories and some of the bigger names that you hear out there. And I think that is going to continue. I know as we continue to talk about the future of Fannie and Freddie, it's an interesting um, position for these investors to be in, giving additional options where, you know, QM loans can still fit into the non-QM bucket. So whether they're preparing themselves for the future or whether they just see the increase of business in non-QM, definitely seems to be a hot topic as of late.
James, you want to dive into that, or you want to second that? Do you want to talk something else? What I do want to talk non-QM. I'm just wondering if anything else has kind of caught your eye to give people a table of contents for today's call that would be new.
Yeah, no, I would agree with a lot of that and happy to elaborate. I think probably the biggest thing since the last time we were all together really is the NBA secondary. Yeah, I thought it was a good conference. It's always a pleasure to see so many familiar faces. In terms of themes, I think on my side, I've kind of been making the joke for a while that the industry has been going through stages of grief in recent years, starting with denial and moving on to anger and so on. And I think we've really reached the point of acceptance about the current market environment, in my opinion. Some years when you go to that conference and you see everybody and so on, it seems like folks are talking about maybe the hot new investor or the product they're rolling out or what the other guy's doing that they're trying to emulate. And there was some of that, but a lot of what I heard this year was kind of heads down, cost controls, efficiency measures, a lot about cost to produce and so on. A lot of conversation about servicing retention and recapture. How are people selling maybe co-issue, for example, to investors that maybe have a superior recapture capability in a call center? And I think it's a tough topic for lenders right now because, with volume presumably on the lower side, it's hard to look a higher SRP in the face and trade it away. But at the same time, certainly there's valid considerations for retaining the customer relationship. So, yeah, I mean, I think again, that notwithstanding, for me, the tone was a lot of back to basics, with a lot of caveats that, no one has a crystal ball. A lot of economists are saying that rates are probably going to be in this general vicinity for a while. So while home inventories may be loosening up a little bit, no silver bullet, back to basics and putting your head down and focusing on execution.
Dad, you want to talk about the stages of grief? You seem to light up when James brought that up. James forgot bargaining and depression. I'm sure those were in there at some point.
That was last year.
No, James, you stole one of the opening lines of my commentary that I have coming up. I think it's true. I think this group has been saying for months now, all right, look, rates are where they are. Probably not going to go up much, probably not going to go down much. There's no reason for them to go up a lot. And there's really no reason for them to go down a lot. And so what are you going to do about it? And so what capital markets people that I'm visiting with continue to do is just try to sharpen their pencil. And it's a bit of a grind. There's nothing glamorous about most aspects of this industry. Hopefully I'm not bursting anybody's bubble here, but the fact of the matter is it's a day in and day out thing. And that includes capital markets and secondary marketing. And you're literally out there just grinding away, trying to find, that next new investor, or trying to, talk to loan officers about why you're charging the margin that you are, or trying to talk to senior management about why you're charging the margin that you are. It's a job. And it's not like we're out there making a ton of money for companies. In fact, I continue to argue that aside from locking in the original margin that you price into the product, most of what capital markets people do is break even and protect the company from interest rate risk. So that's just something to keep in mind. But I was particularly interested, Ira, you brought up a very interesting topic that I think everybody's seeing, and that is this non-QM that we've been hearing about ever since non-QM was invented back when, Dodd-Frank was voted in, and then the CFPB came along, and then QM and non-QM differentiation came along. And ever since then, the non-QM companies, first of all, they had to overcome the we're not subprime education process with the industry. And that took years, really. And even recently, I heard a non-QM investor talking about when it can't go prime, come to us. And I thought, that's kind of taking a step back with regard to the industry's perspective on this. But as we've talked about, nobody wants to turn their client away. And so looking at non-agency products of all types, which include non-QM, I think continues to be really an area where capital markets and secondary marketing people can add value.
Ira, I ask for your thoughts on that, but I'll add the color of I speak with a lot of people, around the industry, and it seems like it's finally turned this corner. Non-QM is filling this void that Fannie and Freddie have almost receded and left. And I don't know if that's planned by the powers that be in Washington, or that's the natural course of when you create a uniform credit box to provide liquidity, it has to maintain some sort of box to provide that liquidity, and you're going to have these creative things come around. Now, the fear would be what would cause us to see something like we saw in March of 2020 when liquidity dried up almost overnight. And maybe you could argue that we've turned the corner past that being something that would happen. But there's obviously a lot to unpack. You want to talk Fannie and Freddie, kind of this fading out from the forefront? Do you want to talk how non-QM has proliferated around it, and it's private money that's where the demand is? What do you think the best direction to go
Well,
would be?
I actually think there's also another direction, and that's the industry getting used to, especially on the sales side, getting used to the product. For a while, non-QM was, more of a niche product, and you could argue that it's no longer a niche product. It's a true valid option for borrowers. And I think loan officers and salespeople are getting more used to and more comfortable with these programs as well, understanding them. understanding how a DSCR product can now fill the need of that Fannie Freddie investment 4-point add-on that they're going to have that borrower pay. So I think, the biggest piece, at least that I see, is actually the loan officer education. And we're seeing more loan officers getting comfortable with the product to fill those needs. We mentioned just a second ago the Fannie and Freddie adjustments on non-owner and second homes. We are actually seeing more non-QM investors or even QM investors rolling out a second home investment product. So on the surface, it may not be a true non-QM product, but maybe it falls into that quasi non-QM bucket. So I think it's the industry sales getting more comfortable with the product. And in this lower environment, borrowers are looking for, additional options, additional avenues to qualify, as well as obviously loan officers looking to grab every deal they can. So where a borrower may not qualify in that Fannie Mae box, they're going right to that non-QM outlet saying, okay, can we do, a borrower had a couple lates on their mortgage. We know that's not going to fit Fannie Freddie, but I'll take that loan now and then hope, I know hope's not a strategy, hope rates that will come down and then we can refi them at a later point.
Yeah, you mentioned almost that crossover effect where it's like, makes my head go to not all rectangles are squares, but all squares are rectangles. And so you might originate a borrower thinking they fall in to the conforming box, but then they ultimately go to non-QM. Are you seeing a rise of that when it comes to what's being originated out there? Yeah.
Yeah, we're definitely seeing a rise. We're also seeing a rise in execution. So we hedge most of our business. So when we close conventional loan and we put those loans out for bid, we will sometimes get bids from non-QM investors interested in that business. So obviously they are not selling that loan to Fannie Freddie. They're either holding on to that loan or doing something else with it. But we're definitely seeing an increase in that business.
And pricing has come in to the point where it's starting to make you make tougher decisions.
Definitely, and especially again on that non-owner and second side of things where we're seeing the investors actually pass through some of those pricing adjustments onto their non-QM side, so that way at least borrowers can take advantage of a little better execution versus the normal Fannie Freddie hits.
So James, we talk, private money coming into the market more and more versus this, government backing when it comes to Fannie and Freddie. What is going to be the future of Fannie and Freddie? Can you explain some of the mechanics behind, what drives actual rate movements and what would cause like, an eighth movement versus 3/8 versus a half when it comes to the demand of private money versus a government backing? And there's obviously been conjecture about, oh, well, if Fannie and Freddie get privatized, rates will go up by 50 basis points. Some people say they might go up by more than that. Where are these numbers coming from? And that's what I mean by the technicals. Where do people decide, hey, it looks like rates will move by this much if we start to see, money act in different ways?
Yeah, absolutely. So a couple things there. You brought up previously the point about liquidity drying up in 2020, and just one thing kind of before I get to that piece is, but kind of related, is it really depends how that investor, what their takeout is. Are they a portfolio bid, perhaps that's selling to someone like a life insurance company? Are they securitizing themselves? And to your point, are they at the whim of the securitization market? One of the things as lenders evaluate their investor partners with respect to anything that's not an agency product, be it non-QM or otherwise, is it's really important to understand where the valuations come from as well, what the ultimate end investor is going to be doing. With respect to the rate movement and so on, it's a really good topic because a lot of this has to do, again, with the type of the buyer that you're ultimately looking at. Fannie, Freddie, and Ginnie have different levels of government guarantee. And despite the fact that Fannie and Freddie are in conservatorship right now, they're still considered to have an implicit guarantee, whereas Ginnie has an explicit guarantee. With Ginnie, that makes it a direct obligation that's backed by the full faith and credit of the United States government. So from an investor's point of view, if I'm an asset manager, I know that that is effectively the same credit risk, if you will, as a treasury bond, whereas that's not really the case for Fannie and Freddie. It's a little bit more complicated again with conservatorship, but the general idea is that they have an implicit guarantee with respect to default. This makes one of the things, so from an investor's point of view, you know, an investor evaluates all of their different investment decisions in a fixed income kind of perspective. Do I want to, if I'm a fixed income investor, do I want to buy treasury bonds, or do I want to buy mortgage-backed securities? Do I want to buy municipal bonds, for example? These are the different kinds of things that they have. Well, when the, you know, to your point, if all of a sudden the agencies come out of conservatorship, they need to be able to stand on their own, and they need to have sufficient capital to be able to withstand, you know, a credit event like we saw, you know, 17 years ago. That's basically the spirit of the market at this point. So as whatever happens with Fannie and Freddie proceeds, one of the things that's really critical is for market participants, and by that I mean bond investors, regulators, banks, bank regulators, the Treasury Department, like all these different interrelated people, to have a really good understanding of what the credit risk is going to be and how things are going to be different or how things are going to be the same. I'll pause there. I know that was a lot.
I think my dad might have some color he can add to that from multi-decade. No, I can ask
Well,
you a hard question. You want a hard question? I'll give you a hard question.
no, I was going to actually, there's Guy Short's, what is sufficient capital? You know, Guy, how high is up? You know, how far down is low? The amount of, certainly the billions that the agencies have been adding to their balance sheets through their profitable operations have helped, but there's still complex financial arrangements that agencies have with the U.S. Treasury, and it's a matter of what the U.S. Treasury, what the president, because Congress doesn't even have to be involved in this apparently, what the president tells the Treasury to accept in terms of, hey, we want Fannie Mae and Freddie Mac to go, you know, and be out of conservatorship, so you have to deal with this. Nobody quite knows, Guy, what kind of capital we're talking about, but I think that in getting into the weeds a little bit, I think if I'm a loan officer, I am looking at what's going on out there and saying, you know, this is actually good. I've got James doing some things. I've got Ira doing some things. I've got, you know, name any capital markets person that's out there. And, you know, they are out there coming up with non-QM investors to help me not turn away clients. And I think that is having a big impact on things. But cautionary tale, in anybody who's been in this business longer than 15 or 17 years remembers the day when, if you go way back into the 1990s or 1980s, you had subprime companies, Household, Beneficial, Ames. You know, there were a handful of subprime companies, and some very top-notch people had their first jobs working for companies like Beneficial, where you find the loan and you process the loan and you underwrite the loan, you close the loan, you service the loan, and then when the borrower doesn't pay, you have to collect on the loan. From that, we always had Fannie Mae and Freddie Mac, and then we had these other quote A-paper investors. Well, come, you know, Headlands and Peter Paul and so forth, companies started to fight over that middle ground between subprime and prime, A paper and C paper or D paper. And so companies were squabbling over A minus or B plus or B, and things, you know, there was like something for everybody in the marketplace. 2008 comes along, you know, the Household, the Ames, the Beneficials, they all go away, and we are left with pure A paper companies, and those become, you know, the AmeriHome and the PennyMac and so forth. We could go back to an environment where you have Fannie Mae and Freddie Mac interested in some of those other products at a certain price, but you also, and we're seeing this now, the non-QM investors have been improving their prices on some of this DSCR and some of these other products, where their rates and prices are actually better than the agencies. And so if you're an originator and you're talking to your capital markets person, and you're saying, well, I'm thinking about this. And the capital markets person really doesn't want you to broker loans away. They want to keep the loans in-house. So there's becoming more of an appetite in the secondary market for some of these kind of gray areas in terms of product and in terms of price that's helping capital markets people and it's helping originators out there. Some originators, Robbie, when you talk to them, they're like, I haven't done an agency loan in 6 months. All I'm doing now is non-QM and non-agency. I don't even look at Fannie Mae and Freddie Mac anymore. And so it'll be interesting to see with what Donald Trump wants, where he wants the agencies to go, and has Bill Pulte carry out his mission. It'll be interesting to see if that, where that goes.
I do want to talk AUS driven jumbo and ARM products on this call. And I know Guy chimed in there and says, what would help him as an originator is a 7-1 ARM that's a little lower than a 30-year fixed. Ira, tough question for you in the sufficient capital vein. In theory, everything should be priced to where there is investor demand. The moment there's less investor demand, price would change to where it then brings them in to the market. That's how a proper functioning market should work. Why in practice is that not actually how it works out when it comes to originating mortgages? You'd think that with enough demand for ARMs, they'd come in at an attractive price,
whatever it might be. I mean, there's a demand from salespeople for the ARMs, right? But when that loan, when we're looking in this higher rate environment, from an ARM that's, I know we've been saying this for the last 2 years, but that we think rates are going to come down and that loan's going to prepay pretty early. Do you really want to be hanging on to that ARM if it's going to pay off early? That's number one. It's the prepay speeds on the ARMs. Obviously, some people are a little hesitant on the ARMs. They don't know what rates are going to do. People say they're going to stay in their house for 7 years, so they want a 7-year ARM. It winds up they stay in for 10. But people that had ARMs, 7 years ago are now going to be coming up on their reset, and how are they going to be feeling in this sort of environment? So I would love to see some agency ARMs as well. We are seeing some slight appetite on the non-agency side of things. And maybe that will play into liquidity a little bit. There was one investor, I'm not going to name them, but they just recently dropped their minimum loan amount for their non-agency product. So basically, your regular agency product can now fit into their credit box on their non-agency side. And that was rolled out this week. So in those situations, we may see an increase, hopefully, in ARM products. But it also adds to the previous topic along that sort of that intersection of QM and non-QM, where we're seeing the intersection of jumbo versus non-jumbo or agency versus non-agency, putting aside non-QM for a minute.
So ever since I was a wee lad in this industry, there's always been the hue and cry from IMB loan originators saying, why can't we match the bank or credit union, fill in the blank? They've got, a 3-1 ARM or a 5-1 ARM at this price, and we don't even offer it, or, we're a full 2% higher. Why is it for the folks on the call? Why is it that banks and credit unions seem to always have those kind of rates and prices?
Yeah, I mean, one of the things that I try and tell people when they bring those to our attention is, listen, you're dealing with a depository. Listen, you're dealing with depository, you're dealing with a credit union. They have cross-sell opportunities. They're desperate for deposits, and they have other avenues of other avenues of making money. So they're not just taking in a 5-1 ARM and selling it off to an investor, or selling it straight to Fannie. They're going to hold that on their books. They're going to have a portfolio product that they hold and they service. And it's basically based on their own cost of funds. So, they'll be able to offer, a better product, but they're also not selling that off at a lower price. So they're holding the funds, they're servicing it. They have those cross-sell opportunities, whether it be a credit card or a line of credit or an auto loan, now that they've captured that borrower. When we talk about, the recapture piece, obviously those, you know, banks and credit unions are definitely going to want to hold on to those borrowers as much as they can because they want those deposits, they want those cross-sell opportunities, and by being able to offer those products, it's a perfect way to capture that borrower, to be able to entertain different offers and different avenues for them.
Yeah, the example that I give, and it's simplistic because that's the way I think is in simplistic terms, is when I'm talking to an originator about this, I'll say, what are they paying you on your checking account? And typically it's like, 0 or 0.5% or something. And I'll say they're taking your money and my money and Robbie's money and Ira's money and James' money, and we're buying it all, and they're paying us basically 0. And they are taking that and loaning it. They have the ability to loan that out at whatever ARM rate they want, whatever 3.1 or 5.1 rate they want to charge. And maybe that's at 4%. So they're earning 4 minus 0 is 4% on that, as a spread. If you look at an independent mortgage bank, the independent mortgage bank is paying a warehouse line to borrow money to make a loan, and then when they sell the loan, they pay off the warehouse bank. I don't know, James or Ira, what are warehouse banks? What are rates right now, roughly, for a warehouse bank?
Well,
Roughly
call it somewhere in the neighborhood of 7-ish%, give or take.
7.
Yeah.
So you as an IMB, every time you originate a loan and you're borrowing money at 7 and you're loaning it out at 7, you probably want to sell that loan as soon as possible. And it's hard to originate loans at 3 or 4 or 5% when you're borrowing money at 7%. I mean, it's a money losing proposition. So it really is a direct impact of what's going on in the capital markets, impacting what's going on in the primary markets for IMBs and for credit unions and banks.
Yeah, and I think this is exactly where understanding an investor's business model really helps and really pays dividends, because that's exactly what Rob just said, is if you're a bank, you're in the business of taking deposits and making loans, and that's your business model. If you're an independent mortgage bank, you're in the business of trying to basically originate loans and make a little something along the way and then get your money back and do that over and over again. It's just different perspectives. And I see the question, so why isn't there a non-credit union investor that is also interested, like a 7-year, like an insurance company and so on? The answer to that would be they are, but they're interested at a price. They have options and they have alternatives too. Generally speaking, they're not going to be deposit funded. So the interest rate spread that Rob just kind of articulated, that's not going to be the case for them. And so they'll happily buy, but they'll happily buy at their own price. And so that basically, again, it just comes down to what their perspective is.
There's another comment in the chat. Ira, you want to address what Dave said there, and if you can corroborate what he's saying?
Yeah, so Dave mentioning warehouse is a losing proposition unless you find a warehouse lender who lends out at a no rate on the file. The warehouse side of things has definitely consolidated a bit in the last few years. There is competition there. They're hungry for the business just like we are, right? You can negotiate your warehouse agreements and attempt to negotiate your warehouse agreements. But it is slim pickings right now in terms of that piece of things, obviously in this lower volume environment.
It's almost like the boy who cried wolf when it comes to warehouse lending. Because haven't mortgage companies been not profitable quarter after quarter after quarter? Yet no one's pulled their warehouse lines just yet, at which point you would have to notify your other warehouse lenders. James, in your opinion, why hasn't that happened when we've seen so much unprofitability quarter after quarter?
That's a great question, and that's something that I've talked about with a few folks in the industry. I think the answer is, at least my 2 cents would be that a warehouse bank is in this business for the long haul, like so many of us are, and they understand that there's ebbs and flows And they're going to be good risk managers as well, and they're going to put in covenants that protect themselves and so on. But at the end of the day, they also understand that what part of the cycle we're in. And I think the real pragmatic answer is if a warehouse bank, I mean, there's a time and a place where, yes, the warehouse banks are going to say, respectfully, we're going to pull, our business relationship, or we're going to move on. But I guess I would just say, like, that's a thing. That's a thing to do. And that kind of gets out as well that, oh, the next derivative of that is ABC Warehouse. Are they getting out of the business? I heard that that kind of thing. So I think that generally speaking, a warehouse banker is more inclined to sit down, work with a lender, review their financials, make sure that, everything's still in a good spot. But even if they are perhaps losing money, make sure that they're comfortable with that burn rate and so on. But I think at the end of the day, to finally get to the point of actually pulling the credit facility, I just think that it's a little bit more material than maybe I would have thought 6 months ago, 6 years ago, for that matter, from the cheap seats. That I think when you do that, it's kind of like, all right, well, you're kind of saying that you're getting a little bit out of warehouse here. I don't know if you guys would add or subtract anything from that.
Yeah, I was going to say we've seen similar, and I think the biggest thing that we've been told is they want to know that you have a plan. They understand the environment we're in. They're dealing with hundreds of clients, so they know what's going on, but they want to know that your company has a plan to get back to a positive number. And if you don't have a plan, that's maybe where they would start to have those conversations with saying, well, we know this environment, but what are you guys going to do? Are you going to make cuts? Are you going to be streamlining? Tell us what your plan is. And more often than not, as long as you are communicating with them, that's sort of the biggest piece.
Dad, anything to add? No. No.
James and Ira did a good job summing it up.
Yeah, I think you both did a very good job there. So we talked kind of, there's originator demand, there's borrower demand, there's investor demand. The elephant in the room, or the roller coaster operator in the room, is kind of the what's happening, through tweets or Truth Social or whatever. And Dad, I know that you love to speak about this, and love might be the exact opposite term, but you certainly have things to say about it. And so when it comes to the ways that the news cycles are unfolding on social media, especially when it comes to Fannie and Freddie, today's news is obsolete tomorrow, and it seems like something new, this and that. What's the best way for people to make heads from tails when it comes to Pulte saying something, Trump overriding him? Is it as simple as listen to what Trump says because he's the commander in everything at this point?
So, Robbie, you're referring to Bill Pulte speaking at the National Secondary. I know I was in the audience. You were there, and him talking about, oh, we're going to talk about conservatorship in 2026. And everybody kind of went, oh, okay. And then a day or two later, Donald Trump said, oh, we're looking at this right now. And at that point, I think Bill Pulte came out and said, well, it's Donald Trump's decision to make, and he will proceed however he sees fit. Well, I get that. However, I'm old-fashioned, Robbie. I mean, I come back to, given that this industry and the changes in this industry impact tens of thousands, if not millions of borrowers out there, millions of people. Changes to Fannie Mae and Freddie Mac and the worldwide investor community, I don't think changes come down to a tweet or some post on X, which disappears, or a speech by Donald Trump saying, yeah, we're looking at getting them out of conservatorship now. I think offhand comments like that tend to do more harm than good. There's a way when you talk to people, veterans in our industry, there is a way of thinking about these things. There are things to look at. It takes time. It's going to take time to take Fannie Mae and Freddie Mac and put them into any other shape. Not only you're dealing with the primary markets, but you're dealing with the secondary markets and implicit guarantees, explicit guarantees, and so on. It's a very complicated issue. If you're, the simplest example I use is if you are a a money manager in London and you just bought $500 million of, of conventional conforming security, uniform mortgage-backed security with one set of assumptions, and that's how you priced it, and you bid that pool, and somebody comes in and changes that and says, well, we know that that was then, but this is now, and we're going to go back to your covenants, we're going to go back to the legal things and change all of that. Well, that's gonna wreak havoc on everybody who owns a mortgage-backed security, and that should be avoided at all costs. And it takes a while to figure out how to do that. It's just not some X announcement in the middle of the night. So,
But if capital markets folks, and actually, hopefully you and I will discuss this during our speech at MBA Florida tomorrow. Hopefully anybody in the audience here that is in the Tampa area come out and say hello to us. But Ira, we started this call, it's like at the point of rate lock in that margin. So what does it matter what, Fannie and Freddie are doing if you've locked in your margin, and at the end of the day, it's like, hey, Mr. Milner, I didn't make you any money. I didn't lose you any money. I just kept it steady. What is all this isn't your whole role to minimize uncertainty and volatility out there when it comes to your pipeline?
Yeah, but I think the key piece is when we talk about, if we're going to talk about Twitter and Truth Social, thoughts aside, we know that the president and his MO, he talks, we know this, right? And we've sort of, the markets don't seem to react as much as maybe they used to, based on some of these tweets or articles or chatter that goes around, because that's exactly what it is. And until we actually have any solid news on this, we're not really seeing as much volatility from those types of not even announcements, they're tweets or social media postings. So you try and take each piece sort of with a grain of salt and say, okay, we know Mr. Pulte is tweeting this, but we know it's going to take a while. And until anything actually happens, we can only deal with the actual facts. And until something comes out, there's nothing we could do to really react to that. I know it might have been the last call where we talked about how typically, bad news typically leads to lower rates, and for a while it was sort of the opposite, where it seemed like bad news was leading to higher rates. Seems like we're slowly getting back into that more normalized flow, where we do see, maybe poor economic data releases reacting, the market reacting like it should to those actual data announcements. And that's sort of what we've been sticking to is, stick to the data, the hard announcements that are coming out, and sort of try and ignore the noise.
Yeah, and I think
what did Robbie? What did Dave write? Dave's been around the business for a
we'll
while.
get to Dave, but James hasn't spoke in a while, and James, I'm hoping you can
Sorry.
also incorporate kind of the academic perspective here. At Panoramic, what is the academic lesson to be gleaned from all of this that's going on right now? Is there any, if anything?
Yeah, well, I think, to Ira's point, I would say things are getting better. 2 months ago, in the wake of kind of the Liberation Day tariff announcements, that was a definite different time from today. But I mean, yeah, from a theoretical perspective, it's important to emphasize that mortgage-backed securities can be thought of as having embedded options in them, namely the borrower's right to refinance. So it's one of the complications in valuing a mortgage, or really any kind of mortgage-backed asset, namely that the investor doesn't understand or doesn't know with certainty when they're getting their money back. All right, so when volatility spikes, when market volatility increases, what's going to happen is that option value is going to be a drag on the valuation of the asset, meaning that all else equal, market rates are going to increase on the margin. So simply stated, higher volatility, lower valuation to a certain extent. And we see that impacting lenders. To your question, why does this matter if we've locked in a margin on day one? Well, if we're hedging, we see that impacting lenders in a number of different ways. So I just mentioned kind of the core basis of an MBS, but additionally, we see things like specified payups, which are the premiums that investors pay for certain types of collateral. They tend to decline in periods of higher volatility, so that's less money in a lender's pocket. And with higher volatility, the lender as well is going to have more frequent reprices. They might ultimately end up padding their profit margins a little bit too, right? So at the end of the day, the volatility that we see associated with a moving market and kind of a frothy market, and you're not really sure which way is up, it ends up impacting the valuation of mortgages a whole host of different ways, and all of which are pretty negative for a lender's pipeline.
And as we said today in the capital markets and the Crispin commentary, any return to traditional risk on, risk off behavior, it's going to cap a potential downward movement in rates out there if we start to see some of this normalization of trade policies and those sorts of things. Dad, you took particular enjoyment in Dave's comment. You want to read it and address it?
No, I can't. I mean, what did Dave write?
So she said, I struggle to remember a time where data has less tangible relevance to interest rate fluctuation. We've seen a lot of times where BLS comes out for the prior month and rates should logically go in a certain direction, and they don't because of a tweet or some snippet from the Oval Office. And obviously, I would say, keep in mind, there's a myriad of data points out there. There's a myriad of things driving investor sentiment, and to say payrolls should be the focus. There's other releases on a Friday. You get Michigan sentiment with inflation expectations. That could be as important as payrolls, especially when there's prior month revisions to the data. There could be a certain treasury auction that comes out that drives sentiment. Taking things with a much more holistic approach rather than saying it's so facto when it comes to something seems to be kind of a better perspective in today's market. Dad, can you add a little color there?
Well, I always love talking about behavioral economics. What motivates people to do certain things or not do certain things, and the same follows with investors. What makes them invest in something or not invest in something? And right now, psychologically, I would say in general, the public is, I keep using this term in the commentary, but terrified, the tariffs, just the volatility. And at some point, yin yang, boom, 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 boom. And at some point, you just don't, you don't jump when you're a boom. It kind of wears off. And I think we're getting to that point where, news comes out, and when I see news, I think that is the actual news. Now, sometimes news comes out and then you see something issued by the government saying, well, don't believe that news, or that's not really the news. And so you just don't know quite what's going on. And when people don't quite know what's going on,
Right.
they tend to hunker down. They tend to not do much of anything. And so investors may go back to the models that have always served them in terms of investing in things that they trust and they know. But I will say that when you look at consumer sentiment and you look at the Michigan surveys and you look at some of these measures, by many, I mean, we're starting to see some cracks in the economy. And normally, to Dave's point, you would think, okay, if the economy is really starting to slow down, we should see rates drop. But we're not seeing rates drop because of tariff inflation. And the Federal Reserve has been pretty much, I mean, Robbie, you follow the Fed as much as we do, if not more. I mean, what are we talking about? Maybe a rate cut, maybe two by the end of the year. We've got
Less than two currently priced in, but
six more months of, and maybe we'll get the Federal Reserve cutting, or maybe not, who knows? But, rates are kind of where they are. So yeah, there's a lot of news that we're going to get between now and the end of the year. But as an investor, you just say, well, you know what? I've got 500 million of cash. I need to put it somewhere. And, I'm going to invest in this. So
there's one other topic I want to bring up, and I know we're just at about time, but James and Ira, I'd love your thoughts on this. We're in kind of these recapture wars right now. Rocket, Mr. Cooper, what's UWM's play going to be? How do you see this either kind of monopolies over certain borrowers and your ability to retain them, or kind of the wars out there for capturing larger swaths? How do you see that impacting the secondary markets or the capital markets?
Well, I think it's like so many things. I think it's nuanced and complex, I guess. On one hand, there's this implicit assumption that just because we sell the borrower's servicing asset to one of the giants, if you will, that they're going to stay with them. And I think that's a very valid assumption. It's not like a crazy idea or anything. But I think at the same time, like I was teaching a class the other day, and someone in the audience, when we were talking about recapture, threw her hand up and basically went on this rant for 3 minutes about how much she really didn't like her servicer because of how much they contact her, right? Good, bad, otherwise. My point is, they, in this particular case, perhaps went a little too far, and now she would prefer that her loan is serviced by someone else. So I think there's that element to it. There's also, when you look holistically at the valuation, like when we sell servicing assets to someone, it also has an impact on the lender's base prepayment speeds, which ultimately impacts the payups they get in the secondary market. So my point is, it's not enough to just sell the servicing asset at the highest price. Someone needs to look at the totality of the execution as well as what it's going to be in the future. But I think the biggest thing that I would emphasize, and certainly as I talk to colleagues and lenders around the country and so on, is it's really important for a lender to look themselves in the mirror and be able to articulate what is their recapture strategy. I understand the boogeyman in the corner of perhaps selling your servicing to somewhere else, but that's great. But if you do retain, are you going to get that next loan? Even if you do recapture that loan, do you have the ability to win a price war, if you will, with a national call center when it becomes that time too? So again, it's a long topic. I want to be respectful of our time, but I think just in general, there's so many moving parts, and I think it's just a little bit more complex than maybe it has been in the past, I guess is what I would try to say.
Yeah, and sorry for being a bad moderator that introduced it at 3:44 Eastern. Ira, anything to add there before we bid people adieu?
No, the only thing I would add is to what James sort of said before, is knowing your counterparties and knowing that, okay, if you're going to sell to one of the companies that you mentioned, is that the bid that you really want to hit? Because of that possibility of the recapture. So that's always a factor when it comes to executing when we're going to sell a loan off, is taking that into consideration.
Yeah. Well, it's been a great show. Like I said, if my dad and I are delivering a session at MBA Florida tomorrow in Tampa, St. Petersburg area. If anybody in the audience, come out, watch us speak, say hello. Excited to see you guys come back next month. I'm sure there'll be new things to talk about. And as always, big thank you to Polly. I can't, even though I got the actor wrong, Along Came Polly is a great tagline for a company. So Along Came Polly. They're here to stay. Check them out, polly.io. Thank you, everybody, and we'll see you next month.